It was the year that shouldn't have been. Europe was going to stop the debt rot. Contagion would be brought under control, and the headlines would be about growth and recovery. But in 2011, none of that happened. In fact, things got worse. Growth stories were overshadowed by a North Atlantic economic crisis, which still has no real end in sight. This week, a special year-in-review edition of Counting the Cost, looking back at 2011 and ahead to 2012. Yes, hello everyone, I'm Kamal Santamaria with your weekly look at the world of business and finance here on Al Jazeera, but as you just heard there, taking on an annual feel, a special edition of Counting the Cost with three leading economic minds to dissect just what went wrong in 2011, what might have actually gone right, and where it all points to for 2012. Now, as always, we like to back up what we talk about with some numbers, but we've taken the decision here that stock markets just aren't the way to do that anymore. Yes, for a long time they were seen as the benchmark of a country's financial health at any given time, but don't employment numbers tell us a whole lot more? As well as saying who's got a job and who doesn't, they tell us about business confidence, economic conditions, and whether everyday businesses employing everyday people are actually flourishing or not. So here we go, and these are not pretty reading, I have to say, first off. The United States, 8.6% unemployment as of November, down from above 10%, but there were a lot of seasonal hirings for Thanksgiving and Christmas in those numbers. You've got the UK at 8.3% in November. The number of 16 to 24-year-olds out of work is at a record high. Spain's the worst of them all, 22.6% in September, absolutely brutal levels of unemployment there. Not much better in Greece, though September's 17.5% did actually show a slight easing. And then we've got a couple of the Asian powerhouses to tell you about as well. Japan, 4.5% in October, which is rising, and 4.1% in China during the third quarter. Comparatively low numbers for those Asian countries, but high enough for them. So those are the numbers, and here are the people to make some sense of them all, and so much more. Our Counting the Cost panel of experts from across the world. We start in Singapore with Mikio Kumada, global strategist at LGT Capital Management. We go to the Tunisian capital, Tunis, for Mthuli Ncube, the chief economist at the Africa Development Bank. And rounding out the panel in London is Andrew Dell, head of debt capital markets for Central and Eastern Europe, Middle East and Africa at HSBC. Gentlemen, I want to thank you all for joining us. We really do appreciate your time today. So let's start where we have to, really, and that is the Eurozone crisis. But I'm interested, seeing as we've got people from all over the world, to get some different perspectives. Let's start with our guest in Singapore to get an outside view. Did you think 2 years on we'd still be here, Eurozone-wise?
Well, more or less, yes, because, you know, the tools and mechanisms and the legal frameworks and institutional frameworks to deal with the Euro crisis just aren't there. This is a long-term and big structural problem, so this is not something that you can solve very quickly, even though I know perhaps even better than many other people, because I work very close to financial markets, that many investors are dreaming of a grand solution, but you know, that's not going to happen that quickly.
So Mikio, the structures weren't there. That's a very good point you make, but they never got there. In the 2 years, there was just such a lack of urgency to get those structures in place, and arguably there still is.
Well, that is true that at least in the beginning, or well, let's put it that way, even through the first half of last year, too many people, and I must say, including perhaps myself, thought that this was a problem that is limited to the periphery, or that can be, you know, essentially pinned down to some smaller economies in the region. As it turned out, you know, it's now infecting basically the core, and finally, at least, we have some more action in the right direction, which is, of course, to change the institutional framework of the European Union. It'll be slow progress, I think, going forward as well.
Mthuli Ncube, let's bring you into the conversation from Tunis there with your view on this crisis, the way it's unfolded. And again, are you surprised that we are still here and still even having this discussion now?
Well, we are surprised by how quickly the crisis has developed. But also we do note that it's not going to be an easy adjustment in Europe. In a sense, some European countries need to undertake the economic reforms that we saw being undertaken by some African countries. Of course, all of this is affecting Africa, although it is a continent that's doing rather well at the moment, but it's not totally immune. And the impact will be through several ways, through trade, through the availability of foreign direct investment, ODA flows, a bit about the remittances and capital flows out to Africa.
Andrew Dell in London, second time we've had you on Counting the Cost this year. You came to Doha and you had a discussion with me about bonds. And I guess this is the interesting thing now. What started as a banking crisis became economic. Sovereign bonds. This is the story now. This is where it's developed over 2 years.
No, I think that's right. I think there's a number of interesting things sort of embedded in this. Clearly, as any economy reacts to stress, that's normally reflected quite accurately in the way that spreads develop, the way CDS and cash bonds, the spreads develop. The more stressed an economy, clearly the spreads tend to go wider. But I think what's also interesting is that actually in the global investor base, there is an enormous amount of liquidity. Now, a number of investors are quite prudently holding perhaps more cash than they perhaps typically would. So that means that there's a certain element of people sitting on the sidelines. But nonetheless, the liquidity is quite high. The liquidity in dollars in particular is quite high. We've seen examples of European sovereigns, Central Eastern European sovereigns, accessing the dollar market rather than euros because the liquidity has been available in the United States. But I think the market functions actually pretty well. People can get transactions done from the emerging markets, and this is a global phenomenon. It's not restricted to Central and Eastern Europe. We've seen African sovereigns, we've seen many Latin American sovereigns, sovereigns from the Middle East, sovereigns from Asia, all accessing the market. So deals are there to be done, financing is there to be done.
So
and,
have we all focused,
clearly,
sorry Andrew, have we focused too much?
The economic situation.
Sorry, I'll just jump in there. Have we all focused too much on the negatives, on getting caught up in the politics, in fact, that this has turned into a political crisis in Europe, and we've all got caught up in that and missed the other story?
Look, the political situation, clearly, as is always the case with markets, politics headlines drives markets, particularly drives some markets more than others, but it would be a mistake to say that it's not relevant. It's deeply, deeply relevant, both in terms of the real economy and also the impact that it has on sentiment and volatility. But let's not get away from the fact that there's been huge injections of liquidity in many, many parts of the world. The central banks have been pretty savvy about how they've managed this in general across the world. So it is certainly not all doom and gloom. At the same time, clearly there are some economic stresses. That would be that's very obvious.
Mthuli Ncube, I'll come back to you. How do you feel, and this is a point you made in your initial answer, I'd like you to expand on it. How comfortable do you feel in Africa about being affected by what's happening in Europe? Our first guest made the point that it's on the periphery, and the periphery is closer to you in Africa, at least geographically. How do you feel about being insulated?
No, Africa is not completely insulated. If you look at North Africa, for instance, North Africa, in terms of exports something like 58% to Europe, is very close to Europe. There's also a large group of African countries whose currencies are tied to the euro. So obviously, if it weakens, they will benefit, I suspect. But Africa is also feeling the pressure, particularly on the availability of trade finance, the cost of such funding. If you have a downgrade, across Europe, which is being threatened by the rating agencies, naturally the banks, they can't be higher rated than their sovereigns. They also be downgraded, and that will push up the cost of borrowing for African countries through their banking system to finance exports and development. So we are feeling the heat a little, but these African countries are still doing okay. Now if you look at the domestic demand within Africa itself, I mean that's been it's been holding up quite nicely with the burgeoning middle class, and also some countries are making progress in terms of economic diversification. Some commodity prices are holding up, so that's helping some African countries. So as a result, Africa, I think, is doing rather better than the rest of the world, frankly, at this moment, but we're still feeling the heat a bit.
Right, and we will come back to that a little bit later on. Before we just carry on, before we sort of start moving away from Europe, there is one more element I want to introduce, and it's actually, we're going to do it through a guest who was on Counting the Cost earlier in the year, a man by the name of John Chambers, who's the head of sovereign debt at Standard & Poor's. The influence that the ratings agencies had this year, not just over Europe, but over other countries as well. Let's have a quick listen to this, and we'll talk more after that.
I think our track record speaks for itself. We've Over a 15-year horizon, we've never had any defaults from AAA, AA, or single A in the sovereign rating space since 1975. We publish our methodology, how we come to our ratings. The methodology centers on political factors, income and economic structure, fiscal, monetary, external factors. And if people read our methodology and they think that it's flawed, then they can come to their own conclusions.
Mikio Kumada, let's bring you back into the conversation from Singapore. What do you make of the way that the ratings agencies have behaved this year? Maybe behaved is too strong a word, but you certainly heard John Chambers there having to defend himself.
Well, I don't have any issues with that. I mean, the credit rating agencies are always a nuisance, particularly from the point of view of the government, but they are just one among many players. So, the better they do their job, and I do see some improvements in their methodologies, etc. in recent times, that's fine. It's not always going to be convenient to the to whoever is rated, and generally more competition in that sector would be a positive thing, but I'm not in the camp that likes to criticize credit rating agencies, I'm sorry to say. There is one point, though, I would like to make, to what we discussed earlier about political headlines or the news media, and generally the headlines focusing on too much negative stuff. I think there is a bit of that, especially if we look at Europe. You did mention unemployment rates, but for example, one unemployment rate that you didn't mention was the German one, which is at, for all practical purposes, at an all-time low, or moving towards one. And the German economy is doing very strong, is performing very well, even at this point, given all these problems. And actually, the weakest markets in the world were in Asia, in the so-called powerhouses that you mentioned. The real bear market in stocks, for example, was in China, despite all the growth and whatever else they have from advantage they might have, rather than in core Europe or even in the US, which has been holding up quite well. So this is a European crisis, but it's not one that is catastrophic for Europe. It is something that Europe can overcome with time and with persistence, and some of it we are seeing now, especially from the core countries in Europe. And I'm afraid those who will suffer more are those who are overly reliant on exports, especially on low margin, not high value added exports, and who also rely on financing from Europe, because what's going on now is a belt tightening in these rich countries and a deleveraging because balance sheets are being repaired. That's not good, very good for financial markets going into next year, perhaps, but it's not the end of the world. It's a repair business.
No, it's not the end of the world. I think that's the point Andrew Dell was making as well. Andrew, have you got something to say there?
Look, I think rating agencies are relevant, and very, very relevant, and they do, a good, honest job of trying to analyse things and express an opinion. They clearly drive headlines. I think it masks some other things as well. There's been without going into the detail, there's been downgrades across developed sovereigns and indeed banks. There's also been generally a stable or improving ratings dynamic over the last 2 or 3 years with many of the big emerging market countries, and that reflects the underlying growth, reflects the underlying risk, reflects the underlying shift in the global economy. The balances are moving south. The balance of economic activity is moving south and east quite clearly. Africa's been mentioned. I'm very bullish on Africa economically. It's very connected to the rest of the world, but at the same time, it's not as vulnerable politically or systemically as it was if you go back 5, 10, 20 years. Middle East, very strong recovery and growth story. Asia, generally speaks for itself, is very, very well reported, and Latin America in many parts is extremely strong. So the rating agencies have an impact. They also do, as I say, reflect some of those shifting positive economic trends, as well as the negative ones that you've already highlighted. Well, we live in a deeply interconnected world, but the connections are changing, and they're much more EM to EM and fast growth to fast growth, rather than the traditional ones that we've focused on historically.
Well, I'm glad you've brought that up, Andrew, because you're saying you're bullish on Africa, and someone else who was bullish on Africa this year and who spoke to us on Counting the Cost just a few weeks ago, actually, was Tim Clark, the president of Emirates Airlines. Now, obviously, he's a businessman, but he had a great economic mind. I want you to have a listen to this as well.
People tended to think of Africa of AIDS, genocide, poverty, tribalism, etc.
And now it's growth.
You have huge growth in these economies. The Chinese could see that and they're in there big time. Okay,
Ahead of
the
everyone
Americans
else.
are in the West because there's a lot of oil there, and the Europeans are saying, "What's going on?" You know, frankly, it's huge, and it's not going to stop because the man or woman in the street now has had a taste. Yes, there will be a degree of pushing the cork down, but that cork is going to keep bouncing back, and it's fascinating.
It is indeed fascinating. Let's get the view of Mthuli Ncube from the Africa Development Bank on what you heard there. The fact that Tim Clark was saying Africa wants to be connected directly to the world. It's not a backwater anymore. There's some great opportunities. And as he pointed out, China got in there a long time ago and is reaping the benefits of a strong relationship there.
Absolutely, the Chinese investors saw the potential in Africa quite a while ago in several places. It's really in the importation of natural resources, oil, gas and other minerals. They also have invested quite a bit in infrastructure in Africa as part of usually packages for resource extraction. And their approach has been governance neutral, if I can use that phrase. But also you've got this growing middle class demand for goods, demand for mobile telephony service. If you look at the explosion in mobile telephony, it's really amazing. The explosion in the demand for banking services, everything consumer products. So the opportunity is there, and really it's for investors to begin to realize this opportunity and see that there's another place called Africa where they could reap higher returns. Certainly the results speak for themselves. Anyone who has invested in Africa in the last 10 years has had a very good return compared to the US or Europe, well, except India, China, but certainly better than Europe and the US. Africa has done rather well in this respect.
Andrew Dell in London, it's a shame almost in a way that these great stories got overshadowed by all the Euro infighting, isn't it? Because there's great stuff happening in Africa and as I said, the relationship between Africa and other emerging markets.
Yeah, I mean, there certainly is, and I think that's a very vivid example of the kind of new connectivities that I was referring to earlier. I actually live in Dubai. I actually flew down to Johannesburg on Sunday, and I flew up from Johannesburg to London overnight last night. It's give or take a 7-hour flight from Dubai. It's give or take an 11-hour flight from London to Johannesburg. Secondly, the interconnectivity between Africa and Asia is developing all the time. Air travel, either directly or indirectly via major hubs like Dubai, is growing all the time. The planes, frankly, are flying full. The economic growth numbers for many of the African countries are very strong. And let me just illustrate a couple of anecdotes. I go to China. Went to China a few months ago from Dubai. I flew out and back on one of the brand new 380s. Every single seat was taken. What's interesting is 80% plus on one leg were Chinese nationals going to Dubai, and on the other leg going back it was probably 90% plus. Compound growth in tourism of Chinese nationals going to Dubai is in excess of 50% per annum over the last 3 years. Dubai Ports World, which is a major global operator of container ports, has invested in a new facility at Jebel Ali. They announced it a few days ago. That will handle transshipments of all sorts of goods between the Middle East, Asia, Africa. So the connectivities are very, very deep and very, very fast developing. We are looking at a very, very fundamental change in the economic connectivity across the world. And in Africa, just going back to Africa for a second, the political situation in Africa generally, Africa is a continent quite clearly, so you have differences country to country, but with a few notable exceptions and in some cases nasty exceptions, the political situation in Africa is far better than it has been certainly in my memory.
Andrew, thank you for that. Let's bring in Mikio Kumada again in Singapore to expand on the influence of these nations. And I'm going to give it its title, which maybe the media invented in the end, and we certainly like using it, BRICS: Brazil, Russia, India, China, South Africa. Countries which are being touted as getting more involved in Europe, or at least through the IMF, sending more money into the IMF funds, getting more influence with the IMF. Do you think that's the way it's actually going to play out? Because I would think a lot of those countries, the people in those countries, could say, well, we've got our own issues at home. How about we look after ourselves before worrying about Europe?
Well, there is a balance, obviously, and I think quite rightly, the main priority in China would be domestic, because we, as I tried to explain earlier, we live in a world in which the so-called rich countries are deleveraging. including the consumer. I mean, just look at what happened to Japan over the past 20 years. So there is a very big interest in the big countries for their own sake to try to turn around the design of their economies to rely more on their own growth, or perhaps on the growth in the emerging world, rather than exporting to these countries which are busy repairing their balance sheets. Now, having said that, on the other hand, because they wouldn't want a sudden collapse or a sudden financial meltdown of sorts, I think they will step into a degree to support it. So we will see some of that next year playing out. We should, however, also not forget that I believe according to some statistics at least, China, for example, already is a very major investor in Germany, for example. So a lot of the investments in the real world, in the real economy, not necessarily through buying bonds, etc., but through employment-creating investment is actually already happening. Yes, I guess the simple answer is yes.
Mthuli Ncube in Tunis, an opportunity, do you think, for the emerging nations of this world to get involved, or perhaps a chance for them to just look after themselves and stay away from the toxic problems in the Northern Hemisphere?
I think they should get involved in helping Europe come out. For a start, for a long time, the emerging markets have wanted to be part of the table, part of the global decision making at the core of it. And suddenly, this is an opportunity, whether it's through the IMF or through some other mechanism, European Stability Fund or its variant. Suddenly, it's time to get involved. But at the same time, be careful about not overextending themselves, because there are still lots of problems to fix back home. There are still some poverty in China, some poverty in India and Brazil and South Africa and so forth. So these need fixing. So a bit of both is required. But suddenly it's an opportunity to join the global community by helping Europe.
Gentlemen, we've got a little bit of time left, so one question to each of you, and we're going to get the crystal ball out now, I think, and have a little bit of a think ahead to the next year. I know it's a difficult thing to do, but Andrew Dell, we'll start with you. If we have this discussion with the three of us, or the four of us again in a year's time, do you think we'll still be talking Eurozone as much? Do you think the obsession will still be with Eurozone, that the politicians will have actually moved on and made something happen?
Look, I think the base economic and political agenda doesn't, change so rapidly. So of course the themes that are prevalent today will still likely be relevant in 12 months' time. But what I do think is also going to happen is that you're going to get a greater recognition of some of the underlying things that we've talked about today, some of the underlying different themes and the way that the world has changed. So you will have a news flow, I believe, that is actually more representative, more balanced, and more complete in terms of looking at the globe, as opposed to being driven somewhat by historical connectivities between economies. So I think the themes don't go away. Why would they go away? But at the same time, new themes that exist already will attract more attention.
Mthuli Ncube, a quick word from you perhaps on crystal ball gazing to 2012?
The problems in Europe will take a while to fix because of the structural issues involved, the difficult political negotiations to be overcome. So I think a year from now we'll see a bit more calm, I think. I think that there'll be a lot of progress made with the treaty or its variant. I think that the situation will be a lot more calm next year, and then hopefully try to tee up for better performance in the next 5 years.
And a final thought then from Singapore, Mikio Kumada.
Well, certainly I do hope that in a year from now we will not be discussing problems so much as we would be discussing solutions and perhaps visible progress. But of course, hope is not a strategy. So I am a global strategist. I help manage money in public markets mostly. So we do stay on the cautious side there as we go into next year. But personally, I do hope that over the course of next year we will find some sort of bottom in markets, and I do hope that the Europeans especially can convince that they actually do have a long-term, at least, solution for their problems. And I hope that we will not get additional structural issues because remember, the US also has a debt issue potentially. So as long as we don't have another theme of similar size, I shall be very happy a year from now.
So a big thank you to our panel for today, our three wise men, I might call you actually. Mikio Kumada from LG Capital Management, Mthuli Ncube from the Africa Development Bank, and Andrew Dell from HSBC. Gentlemen, we really do appreciate your time and your insight. And just a reminder to those of you watching, if you want to get in touch with us here at Counting the Cost, 3 easy ways to do it. You can send a tweet to me if you like, at Kamal AJE, or our business editor at Abid Oliver Ali, all one word. If you're not on Twitter, that's just fine. countingthecost@aljazeera.net is our email address. That is it for our special year-ender edition of Counting the Cost. Still one more edition to come in 2011, though. That is a Latin America special with reports from one of the main growth areas in the world today. So keep an eye out for that one. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.